Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Good day, welcome to the Australian Property Podcast. Good to have you with us. I'm Pete Wargent from Wargent Property Buyers, and I'm here with Chris Bates from the Flint Group. G'day, Chris. How's things?
Mate, life's good. It's Father's Day today. If you're listening to this, happy Father's Day to all the dads out there. We're recording this on Thursday, so I'm off to the kindy this afternoon. 2 days in a row, back to back with my daughter yesterday, and then today at the kindy, which is good. So yeah, happy Father's Day to everyone listening. I went around the class with my daughter and said, "Oh, why do you love your dad?" And I haven't heard about my son why he loves me yet. I hope I'll find out in a few hours. But my daughter said because she loves wrestling with me. So that was a pretty good one. I'm pretty proud of that for the WWF life we live at home. So what's news in your world, Pete? I think you've been at a festival for the last week. That was pretty brave.
I always love those cards the kids do for Father's Day. It makes your heart melt sometimes, or at least most of the time. Yeah, I've been down in the Cotswolds this week. I don't know if anybody watches the Amazon series Clarkson's Farm, but I was down there, went to the Diddley Squat Farm shop and all of that. It's yeah, and we were camping out actually for 4 nights at a festival down there. It's an absolutely magnificent part of the country. I don't think I'd really been there until maybe 4 years ago around the Cotswolds. It's just absolutely beautiful, totally unspoiled countryside and those lovely sandstone buildings. It's Britain in the summer at its absolute best. So yeah, pretty good. I was glad to get home and get some sleep in my own bed, mind you. So yeah, it's just noticing things are still expensive. You know, that's the cost of living pressures around the UK. And I guess the new government is under a little bit of pressure now to deliver in the budget. So, yeah, there's a bit going on there. And, yeah, I'm just in Europe for the next couple of weeks, then heading back down under. So looking forward to that. Yeah, what else is happening?
Well, I mean, I think it's interesting. Our first story, which we do every Sunday, we do the 3 big news stories of the week. But before we go there, I mean, inflation data came out yesterday. What was your take on that, Pete, before I try to steal your thunder?
No, it's all good. Yeah, so the monthly inflation index. So if you're not familiar, this is a relatively new addition in Australia. Normally, we used to get the quarterly or official inflation figures from the ABS, and a lot of other countries do monthly. So we've got this new indicator, but it actually doesn't cover the whole inflation basket. So it's more of an indicator than anything more official. So what did we get? Inflation at the headline level fell from 3.8 to 3.5%. A lot of the, we got lower fuel prices over the month, which you'd have seen at the Bowser, but also from the 1st of July, we're getting a lot of electricity subsidies at the Commonwealth level or the state level. So some of the states starting to get their subsidies hitting from 1 July. But actually, when you dug into the numbers, there was a lot of confusion about whether they started to kick in from July or whether a lot of the households around the country would only get their first rebate instalments in August. But as it turned out, Queensland and WA hit in July, but in the other capital cities, first rebates won't be till August. So it's a bit of a dog's breakfast release. I think this is why the ABS releases some other series where they do an inflation index that excludes volatile items, and that fell from 4% to 3.7 in July. They also do a trimmed mean index, and that fell from 4.1 to 3.8. So they're not really a market mover. I guess it just generally shows that the disinflationary trend is intact, and I think things generally heading in the right direction. I'll just note in passing, so as I mentioned in the UK, shop prices fell for the first time in 3 years. But I think, this is just my observation from chatting to people around the traps. We may well see inflation get back into that 2 to 3% target range. And in fact, that monthly index in Australia will probably see that in the next, probably in the next couple of months, partly because of the government subsidies. But I think, nevertheless, inflation is still going to be a hot topic for consumers for a while, because even though the rate of inflation might be coming back to target, price levels are still really high. I'll just give you one example before I throw back to you, Chris. Went to this music festival on the weekend. Last year, I remember being completely flabbergasted to see a sweet corn for sale for £5, sweet corn and butter. And this year was £6, which is even more ridiculous. And at face value, that's a 20% inflation rate. So, yeah, look, inflation might get back to target, but I think for consumers and everyday people in the economy, they're still going to be talking about cost of living pressures simply because, yeah, the level of prices, particularly for some of the essentials, is still very high.
Yeah, I mean, I guess there's essentials, right, which you can't get away from spending. Maybe you can make some slight cutbacks and change what you eat to baked beans and, switch the light switches off more and things like that. But there's not much you can really do. But, a lot of the discretionary items, Pete, do you reckon that's just inflation working in itself? On top of interest rates, inflation becomes a bit disinflationary because people then naturally decide to stop spending and people have to reduce their prices. You're starting to see that. I mean, I read an article yesterday around, Airbnb, right? And how Airbnb owners are having to reduce what they're renting out for because people aren't, going on holidays as much, right? And doing interstate travel. And, so that in itself is reducing the cost of travel. So what's your take on that, Pete? Is it really the breakup between the essential and the discretionary? And if discretionary gets too expensive, people don't go out for dinner. They don't go to the movies. They don't go out to bars. They just decide to look for an alternative and a substitution.
Well, that's right. This was the argument against government subsidies, say for bill relief on electricity. We may well see that from a year ago, electricity prices after the subsidies are maybe a third lower, 33% or thereabouts. But then this is obviously that hacks the headline rate of inflation lower. But then if that's just freeing up more money for people to spend in the economy, is that going to start actually having a stimulatory effect? I mean, look, I guess generally speaking, if you look at the wages index, well, wages growth has peaked around about 4% and will probably head down from here. But the rate of inflation has been higher. So that should be disinflationary. You've already mentioned, obviously, not captured in the inflation figures is the enormous increase in interest payments on mortgages. And yeah, if you look at the component parts of inflation over the past year, rents were still very strong, up 6.9%. New dwelling prices up 5%. So the housing is still a big chunk of the inflation over the year. But I think in real time, if you look at what's happening to asking rents on the way down, Airbnb, you mentioned on the way down, construction cost inflation, I think in this quarter will be the lowest in more than 20 years. So I think if you look forward, some of those costs will start to come down. I think the one thing that was noticeable in the inflation figures is that some of those services prices are still pretty sticky at this point and haven't really come down. I do think Qantas report today, you'll see some moderation in airfares. That's definitely something I've noticed. But I think generally the RBA is still winning the battle. I think the global narrative is completely shifted. The Fed has basically gone full pivot now. So from September onwards, we're going to get interest rate cuts ahoy for the US, probably throughout 2025 as well. Maybe 8 interest rate cuts or thereabouts priced in. So that changes the global narrative. Once the US is cutting, we'll probably see the UK, New Zealand, Eurozone, and so on. So, look, Australia will probably follow, but it might not be until next year.
Yeah, it's got a different cycle, though, hasn't it? Our peak of inflation wasn't as high as other countries. Our rates didn't go as high. We're going on we kind of lifted later than they did, or not, even though it felt extreme here, it wasn't as extreme as other countries. And so, but, I guess if it reverses, Pete, if, you can see inflation's been a bit stronger, is it lower, I guess, in other parts of the world? I mean, is there a bit of an issue where we cut a bit slower and a bit later than, other countries, and it starts to affect our exchange rate, Pete? Do you think there's going to be an issue where we have to sort of try to match the cuts around the world to sort of protect, our trade? Well,
it's already happened, actually. If you look at the Aussie dollar now trading at 68 cents, I haven't got the graph in front of me, but I'm pretty sure it was down at 63 not so long ago. So that has happened. I think, I mean, as you said, Australia peaked. The rate of inflation actually peaked 6 months later than the US, then Canada, then New Zealand. There's a number of different drivers for that. Obviously our borders stayed closed for a long time, as did New Zealand's actually, but also the lockdowns in Victoria went on for 9 months. So we actually didn't reach the peak rates of inflation until quite a lot later than some of those other countries. So it would probably make logical sense, given that bumpy route back to target inflation, that we probably wouldn't start cutting until 6 months later either. That does seem to be what's happening. Let's look at just some of the other things that have been happening this week. Well, construction figures were disappointing. Resi construction actually went backwards again in the quarter. It looks to me, if you dig into the numbers, actually house building is picking up, largely driven by capital cities like Perth. Quite decent activity in South Australia and parts of Queensland as well. But apartment construction is just really struggling, especially in Sydney, just going backwards and backwards. So we've got insolvencies still rising in the construction sector, but it's just not really making sense for a lot of developers to get into the apartment space. And I guess that's going to be a key driver of the shortage over the next few years.
Yeah, it's interesting. I mean, we'll start getting into our 3 stories. We're at 11 minutes in and we haven't even kicked off. But we have seen a little bit extra interest in doing sort of renovations. Just a little bit, I've noticed a little bit of a movement there. And I was chatting to a friend who's a builder yesterday, and he was saying something quite similar. They've kind of signed quite a few contracts in the last few months, and they're noticing that the desire to sort of lock something in and that fear around doing a build. I think it makes sense, right? Like, you don't want to do build when rates are really high. But if you think, hey, hang on a sec, by the time I lodge my DA, by the time I go and get a builder, and I don't have to pay interest on that money until I've actually finished the build, and it's going to take, a good 12 months. And in 12 months' time, rates are going to be lower, and they're likely to get cheaper. What am I waiting for, right? And so if I can lock in a good builder now, rather than potentially building prices running on me. And so we've definitely seen that slight tweak there, which we absolutely saw that fall off a cliff the last 2 years. And it was out of control the 2 years before that, 21 and 2020. And so, I think that's a change. Let's get into story number 1, Pete, because there's a lot to talk about this, to be honest. Similar to that story, we've already seen some changes.
That's right. So the first story this week, CBA cut interest rates for new borrowers, so not for existing borrowers. Funnily enough, I might have some facilities with said bank. CBA announced they'll cut mortgage rates 0.25% for some new borrowers. I guess why? I guess if you look at market pricing, index swaps pointing to a first interest rate cut by December. I don't know whether this is going to sort of reignite a bit of a mortgage war and whether other banks will follow. But yes, certainly some of the banks have been almost preemptively cutting deposit rates as well. So I think ANZ cut deposit rates by 80 basis points and CBA by 50 basis points. So I guess, it'd be interesting to hear from you, Chris, what that might mean for the market and whether that's actually changing any kind of change of mindset. Because if it's going to show up anywhere in the housing market, it'll be with you guys first, where people start saying to their brokers, well, okay, if interest rates are on the way down potentially, and I think we talked last week about some of the fixed mortgage rates on the way down as well now. Is that starting to trigger any activity, or are people still a bit nervous about job security?
Look, I do think you've got to be careful jumping at shadows, but ultimately, over the last few weeks, we've seen that bank pricing, fixed rates are not too concerned about what fixed rates are. I mean, fixed rates are basically just on, market pricing and, what banks can borrow at. And, often you can find that a bank's willing to give a decent fixed rate and lock you in. But, I mean, do you really want to fix in this environment? It's pretty gutsy to fix right now because you'd have to assume that rates are going to stay higher for longer. And, if rate cuts happen faster than you expect, you could get yourself stuck on a higher rate. And no one wants to be stuck on a higher rate when rates are getting cheaper. It's kind of the opposite of when you've locked in a great rate for 3-4 years when rates ran, that felt great, but you feel the pain of losses much more. And so, even though you're on a 2% rate, you're like, yeah, this is good, but you don't really get the benefit. Yeah, financially you get the benefit, but it doesn't feel that good. But when you're stuck on a high rate, it's extremely painful to watch rates fall, and you not get part of that party. So not concerned really too much about fixed rates, but they are dropping. So it's a good indication that rates are going to get cheaper. But the variable rate's the one I've been watching. And a few banks came out with some better deals, and they've all been sitting on the sidelines the last, probably the last, I don't know what it is, probably May last year, to be honest. So 12, 18 months, they've kind of really slowed down. The banks were complaining they're not going to make any profits, and that the cost of funding is under their, they're not making any money basically on lending, which is a bit bollocks, to be honest. And they still are. They're just not making anywhere near as much as they used to, just because of the competition mortgage brokers have created over the last couple of decades. And they're having to compete more and more for you as a customer, because customers are voting with their feet. Before, banks were just allowed to say, oh, you're loyal to me. I know I'm not giving you the best rate in market, but I know that you're not going to go through the pain of refinancing. Well, in 2020, 2021, everyone realized, hang on a sec, it's actually not that expensive to refinance, and it's not that hard, and I'm just going to do it because there's a better deal in the marketplace. And so the cat's out of the bag. That's forced banks to get more and more competitive with pricing. They all sat on the sidelines. I do think there's a bit of a cult behind the scenes, that maybe there's some secret conversations happening that the Australian public don't know about. But ultimately, they all took a step back together, and coincidentally at the same time. What we've seen in the last few weeks is a few banks start to stick their nose out and say, no, our profits are fine. All our reporting and bank, I think it was a 6 month or the 6 month or end of financial year results came out, and they're higher than expected profits. Oh, wait, no, we are still making, $10 billion a year. Actually, maybe we should start to grow our loan book. We saw a few banks reduce their variable rates, and then on Friday night, CBA reduced yours. And so I think the reason why the CBA was interesting, because it was on a Friday, the AFR picked it up. It was all over the news on the weekend. Lots of people heard about that story. And I was thinking, maybe the banks are going to start doing this when the first rate cut happens. But that in itself was enough, I feel, to just be another, reason why borrowers can get more excited that rate cuts are going to happen. And I think that on the weekend, I do think it had an impact on the market. We saw a number of clients who, particularly on the higher end, I'm talking $2-3 million plus properties, where they sort of had no urgency there because the auctions weren't that busy. They sort of have a bit of time coming into spring, but one client did buy, but quite a few clients have been, properties ran on them way beyond what they thought they were going to run. And I think that's really the bottom end's always been transacting and growth's been quite strong, but the top end's been quite sluggish. And I would say that's a leading indicator. I would say that there's a bit more urgency, and it doesn't take much for buyers to start to feel a little bit like if they don't buy now, they're going to miss out, and they go a bit harder once you miss out. And so I'd be really watching that. There's a bit of news articles this week by Sydney Morning Herald saying prices are slowing down. The next 6 months are going to be really dire. Well, that's if that natural momentum did continue to slow down, yes, but that's not factoring in that rate confidence has changed completely in the last month. And spring's always a bit more of a positive time in the marketplace. So I reckon they're all going to be eating their words in a few months. And they're going, hang on a sec. There actually has been quite decent price growth, not ridiculous, in the last 3 months when they come around to Christmas time. What do you think?
Yes, I'm just looking at market pricing and for interest rates, for the cash rates anyway, by July next year, under 3.5%. And then if you look out to the end of next year, probably about 4 interest rate cuts priced in the time of speaking. So, look, it's not as much easing as some of the other countries like the US might see, but I guess the downward trajectory is the important thing for confidence. You're right, the banks do seem to run a bit of an oligopoly in terms of the mortgage rates that are put on offer, and margins actually seem to have held up pretty well for the banks. It was also interesting to see APRA's Chair Lonsdale this week talking about the 300 basis points lending assessment buffer staying in place for the time being. So no signs of any movement from the regulator. I think just some general concerns about deteriorating labour market and rising unemployment rates globally. So look, that's where markets are looking anyway. But in terms of what we're seeing as property buyers, yeah, plenty of activity. I don't think there's no sort of frenzied rush to buy or anything like that. But there is some more investor activity from a year ago. APRA said they're not really concerned about housing prices or investor lending. But yeah, maybe just a little bit of a shift in mindset, I suppose, from a month ago. Because as you said, there was a lot of debate about whether we might need more interest rate hikes. But the narrative globally has shifted now towards when are interest rates going down and by how much. And I think Australia probably towards the end of the year will be having more of those conversations as well.
Yeah, I think it's I don't think it's set in stone yet. I do think we just need to see the next few weeks, but, market and sentiment can move quite fast. And, if you start to see in the news over the next few weeks, oh, hang on a sec, auction clearance rates are really quite strong. And yeah, there's a little talk every time at this year. And just be careful when you read articles that there's a lot of articles out right now that listings are higher than 12 months ago. And you go, well, that means that, there's a lot of listings on the market. Well, no. Go and compare to like the last 3 years, the last 5 years. Go look at 10 years ago, and you'll start to realize that all-time, total listings are really, really low. Maybe there's a bit of new listings on the market, and and get some more detail, because a lot of the news articles keep going on about this. There's more listings on the market, and they're sort of like playing into this, that there's a lot of choice. There really isn't a lot of choice, Pete. And I think you'd have to say that, particularly in Brisbane, actually, there's very few quality properties on the market in our capital cities.
Oh, absolutely. Yeah, we've been involved in a couple of purchases this week, and there's been we had one property with 12 offers, which we were successful on, but we've missed out on others. So yeah, there's plenty of competition for the properties that tick the boxes. I don't really like that phrase, but it's for want of a better phrase, for the types of properties that are highly sought after. And just not much quality stock on the market. There's bits and pieces around, obviously. And I think listings are up actually a little bit in Sydney and Melbourne. But yeah, in terms of actually sort of properties of the A grade type, the listings are still pretty low overall. I think that kind of feeds into our second story, really. S&P Global Ratings put out their latest figures on our MBS performance. In plain English, mortgage arrears, which seem to be pretty steady, really. I think there's some sort of talk about potentially mortgage arrears rising over the rest of the year as unemployment rates go up and interest rates at higher levels start to bite a little bit more. But prime mortgage arrears in Q2 were actually pretty steady at just under 1%. And in fact, for investors, prime arrears anyway, for prime borrowers fell to 0.79%. I think when you look at the reasons for that, I think it's because housing prices have been really strong in Perth, pretty strong in Queensland, where generally speaking, arrears have been above average, especially WA actually over the past decade. And some of those arrears are starting to come back down now. So the national level has sort of improved the picture. I think some of the non-bank lenders are starting to report a little bit of stress, which kind of makes sense because sometimes it's the lower qualified borrowers that go to those banks. But generally speaking, things seem to have held up pretty well, all things considered. I guess the low unemployment rate has helped. Are you getting any sort of feedback from clients, Chris? I did see that it looks as though the pandemic savings have now largely been spent or have just kind of evaporated. There was a big spike in the savings rate, obviously 2 or 3 years ago, but it seems that households have generally chewed that up now.
Yeah, I do think I was looking at, put me on the spot here a little bit, I'm thinking about the offset accounts. I do remember seeing some data recently, and I was surprised just how much money is still floating around in clients' offset accounts. You would not have expected arrears to stay as low as they have over the last 2 years with the massive increase in interest rates, right? So this is a number that, people would naturally have thought people are going to, really struggle with their mortgages. They're going to fall behind. There's going to be this forced selling. And everyone's been surprised by how resilient they are. Now, absolutely, you would see that some people are just getting out. It's just, I can think of a number of clients that, just cannot see a way through this. But rather than go into arrears, they're actually just selling and downsizing, or they're getting out of the market. And, and that's just naturally what has happened. That's not a great situation for them. Some has actually not been a bad move. They've been able to reduce their mortgage in the process, and maybe it's not a house at the same purchase price, but it still ticks all the boxes they need for a family. And so, I do think you're going to see it in the non-banks, and particularly where a lot of investors are, and hence why a lot of investors have bailed over the last couple of years. You can see that, if you are struggling with your portfolio of properties, do you sell your home or do you sell your investment properties? And I think that is absolutely going to continue while rates are high, even though rents have gone up. But at some point, those rents will probably stay the same. They probably just won't go up anymore. If mortgage rates come down, those properties start to become much more, the cash flow becomes much more digestible, particularly because the biggest cost is the interest rate. So if interest rates drop, 2%, let's say, over the next couple of years, that's a huge, difference to their cash flow. And it goes from maybe something that's decently negative cash flow to neutral or slightly negative. And I think that we're going to see a lot less investors having to bail, particularly because their home mortgages dropped 2% as well, so their cash flow is freed up. And I think a lot of the wage increases haven't really flown through. A lot of bonuses because people switch jobs and take some time. And so, I don't see that arrears rate, particularly because unemployment's just stayed pretty low. That has meant that people have kept their jobs and have done everything they can to keep paying their mortgages.
Yeah, a few of the conversations I've been having with clients or people who just phone up for a consultation call is, things are, the negative carry on a property might be pretty punishing at 6.5% mortgage rate, but at 5.5%, it starts to look a whole lot better. And I think we're just in that situation now. We're kind of in limbo a little bit, where people are looking ahead to a year's time and thinking, okay, maybe things might not be so bad if the mortgage rates just start dipping down a little bit. But definitely, a lot of investors who bought when mortgage rates were nearer 2 on fixed rates have seen some pain over the past year or two. And as you said, quite a number have bailed. So let's move on to the third and final story of the week. Australia introduces a students cap. So I guess the government needs to be seen to be doing something about population growth, which has obviously been running very, very high over the past couple of years. So capping student visas at 270,000 for next year. So there's some logistical challenges around that, around deciding who will be able to come. I suppose the proposal could yet be blocked as well. There's been some massive pushback from universities, as you might expect, in the media, social media, or pretty much everywhere you look, really, because universities in Australia, let's face it, they've become very heavily tilted towards international students over the past couple of decades. So we'll come on in a second to look at the implications for the economy and property and rental markets. But I think there's some interesting analysis from Tarek Brooker. So if you're not following him, his handle is at Avid Commentator on Twitter, or X as it's called these days. So give him a follow, some good analysis. So he did make a good point about the loopholes around this proposal, because on the face of it, 270,000 looks like a significant drop, because for the 2023 calendar year, there was over 550,000 student commencements, but a whole load of students, as he's pointed out in his analysis, don't actually count towards the cap. So postgraduate research, school students, ELI, COS students, the ESL, non-award students, government-sponsored students, people parts of transnational arrangements or twinning arrangements, or even in some cases, students starting a new course at the same institution and not count towards the cap because of, well, who knows why. So I think, look at the headline. This looks like a massive change, but I just wonder whether, we got a huge number of commencements last year, and we should expect some normalization anyway from 550,000. But maybe actually when you go through all of these exemptions and figures or loopholes, I guess, maybe the impact might not be as significant as it first looks. And in any case, maybe it won't go through. But let's say we get a drop in the number of students. What do you think potential implications, I guess, for the economy? I think reading between the lines, what this is saying is the labour market is no longer as tight as it was, and actually maybe the unis can take some cuts to the number of students. What do you think?
Oh, I think in this world where you've got higher house prices, a rental crisis, people look for people to blame. And, they can blame the international students, they blame immigration. And, it's not that simple, right? And should we be letting international students come and, go to our universities? And, are they productive for our society? And do they bring money in? And do they end up staying and becoming part of our workforce? I think we've got to be really careful how we play this debate. Obviously, there's a limit that we need to be conscious of, right? Because there is impacts on our rental market usually. But I think you got to be careful. There's a global war for talent, not just, university students, but, after they finish university. And so I think we just got to be, careful that we need to make sure that the doors are open for people that want to come and study here, Pete. That would be my take. What's your take on this?
I mean, look, from a purely economic perspective, if universities are charging significant fees to international students and people come and they spend, it seems like a win-win. I think like the counter argument, apart from the rental market situation, which is somewhat debatable because there's some student-specific accommodation and so on. But look, I think what universities should avoid, and I think most people would agree, is bringing in people who aren't really at degree level or postgrad level, and people who pay their fees are getting the visa and coming in. I know this was a challenge in United Kingdom, even from when I was at uni, which is a fair few years under the bridge, with people coming in with very broken English and taking degrees. And but it was essentially a case of if you pay the fees, you're in. And I guess, look, there's going to be some proposed reform of the sector. I think Australia, I read on the ABC, has the second highest share of international students in the world, only behind Luxembourg. So it's the country's fourth largest industry, according to the ABS. So there might be a wider crackdown. Just a couple of things from the ABC that I'll quote here. So student numbers to be capped at 270,000 with individual limits to be set per institution. The new cap would be about 7,000 below pre-pandemic levels and about 53,000 below the figures last year, according to government analysis. So there's about 10% more students in the unis today than pre-pandemic. So, yeah, I mean, look, I guess the caps are probably a part of a bit of a wider effort just to crack down on the quality, I suppose. But, yeah, look, there's no end of media articles coming out from the higher education institutions pushing back against this. So, yeah, what do you think in terms of impact on the housing market? I think I've seen some analysis that suggests that students generally go into student accommodation, but I assume just the sheer weight of numbers must push quite a few people into the private rental market as well.
Look, I think if it slows down our rental crisis, that's a good thing because there is a bit of a dynamic issue right now where investors are bailing. There's not enough investors coming back into the market, and there's increasing demand, naturally because people are leaving homes and can't afford to buy. So that's creating more rental supply. You've obviously got, I don't think people are able to escape the capital cities as much as they were a couple of years ago. I think that return to work thing is really swinging back to the office, particularly for the younger generations who are more likely to be renters. And I read an article this week that Gen Z are the ones leading the charge back to the office because it makes sense, right? If you want to climb the corporate ladder, you need to be seen, you need to be trained, you need to do the office politics to do that. So, I just think that's where it's to slow down the rental price growth. But ultimately, if there's less pressure in the rental market, that does flow on to less pressure to buy. That's been one of the things that have supported prices a lot over the last 2 years is that renting hasn't been a good option in parallel to, buying hasn't been a good option because rates are really high. And so people don't really want to buy in high interest rate environments, but they've been forced to buy because renting hasn't been a good option. They've also been forced to stay in their property and not try to do an upgrade because they look at it and go, if I get out now, what am I going to rent? And I actually think when people have really struggled with their mortgage and, they've, felt like they're, going backward cash flow, they've asked their parents for help. And the parents are going, well, yeah, I don't want you to actually enter the rental market because I know that, the cost of selling and buying are there, stamp duty selling costs, and the market could move if you sell at the wrong time. But I think the rental crisis has been a really big stressed sort of cushion, holding back people transacting in this market and pushing more buyers in. And so I think that'll hopefully subdue a little bit, but I do think it's a headline grabber, Pete, if I'm honest, this story. And, I think it'll be just washed a few weeks down the line and people will forget about it. I don't think it'll move the needle too much.
Political announcements, I guess, when population pressures have been great. It's one of the things, or one of the levers that the government can be seen to be pulling. But how much it actually proves to make a difference, we'll have to wait and see over the next 12 months. Tarek points out some of the potential loopholes and drawbacks in the proposal. So that's it for this week, I think. So don't forget to join us at the Rask Community Forum. You can just Google that. That's the chat forum where you can come and ask your questions on property and, in fact, on investing generally or business. If you want to have a chat with Chris about mortgage broking questions or anything in the lending market, the link's in the show notes. And likewise, I've got a couple of weeks, generally pretty quiet, actually, until I head back to Australia. So if you want to have a chat one morning, just click on the link in the notes and you can book in a consultation call. What's on for the weekend, Chris?
Father's Day here. So playing football Sunday morning, which is probably not what fathers should be doing. You probably should be hanging out with the kids and having a nice brekkie somewhere, but I'm playing football. And then we're actually going to take a boat out on up in the Ku-ring-gai National Park and with a friend and their kids, and we're just going to go and cruise around the Hawkesbury. I think it is up there. I don't think it is the Hawkesbury, to be honest. But anyway, that should be fun on Father's Day. And what about yourself, Peter? You going to get sport on Sunday?
Yeah, watch out for those hamstrings. Yeah, we usually have a pretty quiet one for Father's Day. And then looking forward to the AFL finals. Lions have got Carlton in the next big game, so we'll see how that one goes. Could be a bit hit and miss, but we'll see. Hopefully Lions can push home and continue with the season. Been very patchy this year, but we're still there. So, that's it for this week. So, thanks for joining, everyone. It's great to have you along. We've had over 50,000 audio downloads per month and 30,000 unique listeners. So great to see a growing audience, and thanks for all your comments. And if you have any questions about what you want us to cover, as always, just shoot us a message and we'll try and incorporate. Have a great weekend, everyone, and see you next time.
Happy Sunday.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.